Most people have exchanged currency before a trip abroad. You hand over dollars, you get euros back. That same exchange is happening trillions of times a day across global markets. And that is the foundation of Forex trading. Forex, short for foreign exchange, is the act of buying one currency while selling another. The goal is to profit from the movement in price between the two. It is the largest financial market in the world, and it runs 24 hours a day, 5 days a week, across trading sessions in Asia, London, and New York. Here's how it works at its most basic level. Currencies are always traded in pairs. Take EUR-USD, the euro against the US dollar. If that pair is quoted at 1.1000, it means 1 euro buys $1.10. If you believe the euro will rise against the dollar, you buy the pair. If price moves up, you profit. If it moves against you, you take a loss. That is the core mechanic. Now, what actually moves these prices? Supply and demand, driven by real-world events. Interest rate decisions from central banks are one of the biggest drivers. When a central bank raises rates, its currency often attracts more investment. Economic data matters too. Reports on inflation, employment, and growth can move markets sharply, especially when the numbers surprise traders. And then there is global sentiment. When confidence is high, traders take on more risk. When fear rises, money tends to move into safer currencies like the Japanese yen or Swiss franc. For beginners, starting with major currency pairs makes sense. Pairs like EUSD, GBPUSD, and USJPY tend to have tighter spreads and cleaner price movement. A spread, by the way, is the difference between the buy and sell price. It is effectively a trading cost. There are a few other terms worth knowing early. A pip is a small unit of price movement. For most pairs, 1 pip equals 0.0001. Lot size refers to how much of a pair you are trading. And leverage. This one matters. Leverage lets you control a larger position with a smaller amount of capital. At 30-to-1 leverage, a small move in the wrong direction can cause significant losses. Leverage cuts both ways, and most retail traders lose money. That is not a warning to ignore. The practical takeaway is this. Before you risk a single dollar, open a demo account and trade with virtual funds. Pick 1 or 2 major pairs. Check an economic calendar each morning so unexpected news does not catch you off guard. Set a stop loss on every trade without exception. Consistency and discipline built on a demo account are far more valuable than any shortcut.